Hello, my colleagues, and I hope everyone is doing well. I want to pick up here on section 11.3 about how do we know, since we already found the initial investment, how do we find the operating cash flows? And these are defined as the net incremental, and the important words are after-tax cash flows. Okay, after-tax cash flows that occur after a firm makes new investment and begins operating with the new investment in place. So we're going to have to determine how to do the kind of like a spreadsheet. It's almost like an Excel spreadsheet, and get these and we'll get these cash flows. And again, and like I say spreadsheet, and they say we're going to use the income statement format to clarify by what we mean by incremental tax cash flows. But it'll look like a spreadsheet. You'll see. All right. So cash flows represent, right, any cost incurred by the firm, and cash inflows represent dollars the firm receives and can spend, and vice versa, right, if they have outflows. So remember, cash flows are not accounting profits. So basically, when it comes to accounting, firms expense a portion of the cost through depreciation. All right. So please bear in mind there's a big difference between showing cash on a cash flow statement and accounting principles here. And if you've taken an accounting class, I think you know what I mean. All right, so again, now we got to figure out what do we mean by after tax, right? What is meant by the term after tax? All right. So they must be measured on an after tax basis. It has to satisfy the government's tax claims and capture the government's tax refunds, credits, or other tax breaks. All right, so they have a nice blurb. So read this. If you have any questions on what they mean here, let me know. All right, so let's go through this example 11.6. So Powell estimates its revenues and expenses with and without the proposed. So they're going to buy a machine, right? And they're going to look at what it's going to cost them with the machine and without the new machine. So it's with or without the machine, all right? So that's what they're going to do here. So we already went this. So we're going to look at table 4. So the usable life of the new machine and the remaining usable life of the old machine are 5 years. The new machine's depreciable value is the sum of $380,000 plus $20,000 installed costs, and they're going to use Maker's depreciation 5-year schedule. Okay, Maker's is a depreciation schedule, and it stands for Modified Accumulated Recovery System. So it's a recovery system for depreciation. And we're going to do it on a 5-year system. The resultant depreciation for each of the 6 years, as well as the remaining 3 years of depreciation on the old machine. And so we're going to look at table 11.5 here. So here's the revenue and expenses first on table 11.4, right? Revenue and expenses for table 4. So here's the new machine, and here's the old machine. So here the revenue now, because they bought a new machine, they're going to get more money compared to the old machine. You see this here, the difference? Look at the old machine and the new machine. And here's the expenses with the new machine, which are constant, right? And here's the expenses with the old machine, and these are they vary. Okay, so we have two conditions, a new and an old machine. All right, now let's look at the depreciation expenses for the new and the old machine. Here's the new machine, and here I am. Again, now here's the maker's depreciation percentages, okay? So this is the modified accelerated cost recovery system, and you can look at table 4.2. They tell you if you want to read more about this. So you just multiply these, and you can clearly see after 6 years, I know they say 5, but there's always an extra year because it's done in the middle of the first year. All right, and so here it is fully depreciated. All right, and here's the old machine, and you're in the fourth, fifth, and sixth year of depreciation for that, so that's fully depreciated. Because the old machine is at the end of the third year of its cost recovery at the time the analysis performed, it is only the final 3 years of depreciation. All right, so you can see it's fully depreciated, and there's no more. It's been fully depreciated up to here. And you add these three up, and you get this. Okay? All right. So table 6 now will show us the actual way we're going to do this. And as I said, it almost looks like a spreadsheet. They call it an income statement version, and I call it a spreadsheet. How to calculate the cash flow each year. And note that we exclude interest because we are focusing purely on the investment decision. The interest is relevant to the financing decision, which we will address later in the text, but we're only doing the cash flows each year. Only the investment decision here. All right, so if you want, you can review some of this stuff. They tell you to review some of the stuff in Chapter 4 when it comes to, because some of you people haven't, if you haven't taken it, you should go to the slides or read Chapter 4 in your textbook. Okay? All right, so here's the way we do this. Here's your revenue. Again, this is very similar to an income statement, or, and you subtract off the expenses, but you don't subtract off depreciation and interest, all right? So after you subtract that, you get EBITDA, you get EBITDA. Okay. So it's simple, the math is simple. All right. And then you subtract off the depreciation here. And that leaves you with EBIT because you got rid of the depreciation, right? So now you're down to EBIT, all right? So you're working your way down. Highlight that. Now you subtract off your taxes, so now you get rid of the T. And all you're left with now is the net operating profit after taxes, otherwise known as NOPAT. Okay? So now you're left with this. And they show you how they got that. It's EBIT times 1 minus the tax rate. So that's what you just did right here. Okay? Now you notice that they put the depreciation back in, because depreciation is a non-cash charge. You subtract it off the depreciation. This is very important, by the way. So the depreciation goes back in. So first you take it off, and then you put it back on. All right? That's important. And that leaves you with what's called your operating cash flows. And again, look at Chapter 4, and you can read up on that, all right? So they do all that, and here it is with actual numbers. So you should make sure you go through all these numbers and understand what they're doing here, all right? Just go through, and you can clearly see they're doing that. I would go through this table very carefully, all right? This is with the new machine, and then when you get down here, this is with the old machine, okay? So I drew a red line here, right, to separate the new machine up here from the old machine down here, okay? I want everybody to see that, all right? So, anyway. All right, so you go through all these numbers. It's very, very important. Alrighty. So I'm going to stop here. I'm 10 minutes in, and I will make another one, and we will pick up right here. All right.